Hello and welcome to Charting the Markets on Monday, the 15th of May. Optimism surrounding the budget negotiations in the United States with US President Biden expected to meet the House Speaker Kevin McCarthy tomorrow have helped equity markets bounce back. And on the back of stronger Asian markets, the FTSE 100, as you can see here on the daily financial bet, has managed to open this morning on a stronger footing and is basically gradually heading back up again towards the psychological 7,800 mark, and also last week's high at 7,817, as you can see here on the daily financial bet. Now, this is happening ahead of tomorrow's UK unemployment data. And from a technical perspective, really what we're seeing here is a sideways trading range, which has been in place since the beginning of the month. And for this to change and for the March to May uptrend to resume, what we really need to see is a daily chart close above the 8th of May high at 7,817, and also ideally a daily chart close above this 1 month downtrend line, which comes in around 7,840. And in that scenario, we would then most likely resume our ascent towards the psychological 8,000 mark. But basically, whatever happens from a fundamental point of view, provided we stay above last week's low at 7,679 on the blue chip index on a daily chart basing closes, we should remain in positive territory and continue higher. If we were to, however, fall through and close below 7,679, then a further consolidation may take us all the way down to the late March high at 7,587, and also to the 50% retracement of the entire March to May advance, which can be seen around 7,575. Now, I personally, for the time being, expect further upside to be seen, provided we stay above 7,679, simply because the corrective phase we've seen so far can be subdivided into 3 waves here, and potentially even 5 waves. So we would expect to see at least a 3-wave consolidation of this recent decline. And as I say, provided we stay above the recent lows, further upside is likely to take shape. The same story is really true in Europe. If you look at the DAX 40 contract, this has been trading sideways here around the 16,000 mark on the upside and the 15,700 area or so on the downside for the last 2 months or so. And earlier this morning, we had another attempt at reaching the psychological 16,000 area here, which basically capped us at the beginning and also last week, at the beginning of May and last week. But we have come off that attempt to head higher again short term on Eurozone industrial production data, which came out for the month of May earlier today at a much worse than expected 4.1% versus an expected 2.5% decline, and also versus a positive reading of plus 1.5% in February. So that has put a slight dampener on proceedings short term, but here also, provided we stay above the last reaction low, that is to say the low on a candle here, which is lower than the previous day's candle and the next day's candle, and that is to say last week's low at 15,756. Provided we stay above there, further upside is more likely to be seen than a reversal to the downside. Failure at that level, though, would mean that we would most likely head back down again towards the early May low at 15,659. Failure there would probably mean that a top is being formed, but this is currently not what I expect to see. Instead, further sideways trading with an upside bias is the most likely scenario for the time being. And if we were to manage to break above the recent highs between 16,005 and 16,009 and do so on a daily chart closing basis, what we can then expect to see is a rise to take us back up towards this resistance line going back to November of 2021, which can be seen around 16,180. So that would be the next upside target. But as you can see here, volatility has really come out of the market over the last 5 or 6 weeks. And we are now heading into this phase where equity markets tend to underperform between May and October of each year, and where over the summer month, at least at times, as is the case at the moment, volatility may decrease quite drastically. Now, if you look at the Dow Jones Industrial Average, as you can see here, we've seen a sell-off over the last couple of weeks on the back of the US regional banking crisis, taking the Dow Jones Industrial Average down to a one-month low at 32,935 at the beginning of May. Since then, we've had attempts of a recovery, but those failed last week at the high of 33,782. And this might now short-term be back in sight, depending on whether progress can be made before the US government cutoff with regards to its budget on the 1st of June is reached, and whether we can see President Biden agree with the Republican Party with regards to a debt ceiling, and whether those negotiations will come to fruition before the 1st of June, when the US government will hit a default if nothing is being agreed until then. So we can expect volatility to pick up again over the next few days. Short term, it looks as if the current optimism with regards to the talks that are taking place tomorrow might take us back towards the high seen last week of 33,782. If we were to rise above there on a daily chart closing basis, we could then be heading back up again towards the April and May highs between 34,133 and 34,263. So that would be the next upside target in case of a bullish scenario taking shape, and as long as we stay above the last reaction low at 32,935 on a daily chart closing basis. So these are the sort of technical levels to watch out for with regards to the Dow Jones Industrial Average. The US dollar has risen over the last week or so and has appreciated versus many currencies such as the euro. And you can see this on the euro-dollar chart, which has fallen all the way back from its multi-month high at 110.95, which was made at the end of April, to currently levels seen at around 108.50, last traded on the 10th of April. So you can see here, short term, we're trying to hold, but if we were to fall through last Friday's low at 108.48, we would have the 108.32 low from the 10th of April back in sight, together with the 108.04 high, the mid-February high. So these would be the next downside targets for euro-dollar. But there, together with the low seen on the 3rd of April at 107.89, we might see the currency pair stabilize and then perhaps head back up again. But as we can see here, we have now formed a top of formation with regards to euro-dollar. It does look likely that short term, at least, we can see some further US dollar strength, also influenced obviously by what the outcome will be with regards to the US budgetary negotiations taking place between President Biden and House Speaker Kevin McCarthy and the other congressional leaders of both the Democratic and the Republican Party in the United States before the 1st of June date, basically when the US government is going to run out of money if no agreement is going to be reached by then. Moving on to euro sterling, what we can see here is that we've seen a recovery rally take us back towards the 200-day simple moving average here in red at 87.40, which currently still caps the currency pair. And this recovery already has happened from last week's low, which was made at 86.62, a level last traded back in December of 2022. So here a 5-month low having been reached on this currency pair before it recovered slightly. But for the recovery to actually gain traction, it would need to rise above the red line, the 200-day simply moving average at 87.40, in which case we could then head back up again towards the 88 area. But short term, as long as we're capped by the 200-day simple moving average, which, by the way, is the first time we are trading below it since back in August of last year, So maybe this is telling us that there is a shift now taking place with regards to this currency pair, because after all, since December of last year, we've been sideways trading here between roughly 90 cents, 90 pence and 87 pence or so for the most part of this year. So this will be interesting to see over the next few days and weeks whether we will fall through 86.62, in which case we could be heading back down again towards the 85 area, or whether once again we are holding around the 87 area and then reintegrate this sideways trading range in the coming weeks and months. Dollar yen is also an interesting currency pair. As you can see here, the US dollar is appreciating quite strongly versus the Japanese yen, and is on track to have its third day of consecutive gains, take the currency pair back above the red line here, which is the 200-day simple moving average at 137.01, and towards the March and also the current May highs at 137.77 to 91 with regards to this currency pair. So it looks as if further upside is in store for dollar yen, and this will be the case as long as we stay above the early March low at 133 yen and 51 sen on a daily chart closing basis. So here you can see the momentum has now shifted to the upside again. We can see that with last Friday's sharp move higher, this bullish candle here being followed to the upside by today's bullish candle as well. Commodity markets have been quite volatile of late, with the price of gold coming off a one-year high. But before looking at that, I'd also like to mention what has happened with regards to Brent crude oil. And you can see here that on the daily financial bet of Brent crude oil, we've had a recovery rally from the early May low at $71.40, take us all the way back up towards the $77.50 area. But then last week, after trying 3 times in a row on 3 consecutive days to rise above that high and failing, we have now slid back again, and earlier today reached $73.36 on this daily financial bet. So from a technical perspective, we are still within a downtrend. As you can see here, we have a series of lower highs and lower lows, and as long as we stay below last week's high at $77.51 on a daily chart closing basis, it is possible that we may retest the March and current May lows between $71.40 and $70.09. But if we were to hold here, and if we were to rise back above $77.51, then I would expect the February low at $79.04 and also the $80 mark to be reached pretty quickly. But as I say, short term, it looks as if further downside on these lingering recession fears is the more likely scenario, and we'll have to see how that evolves in the course of this week. Moving on to gold, as I've just mentioned, we had a rally take us to $2,082 per troy ounce just last week, and that was a level which basically took us back to levels last seen, well, that was intraday, basically a new all-time high here on this daily financial bet, taking us above the highs seen in August of 2022 at $2,075 and the March 2022 high at $2,070, but only on an intraday basis, because if you look at the daily close on that day, that was actually made around $2,050, and since then we have actually come off. And I'd like to show you this chart because from a technical perspective it's quite interesting, because you may remember me saying that we were likely to break out of this triangle formation just a couple of weeks ago, which we then did at the beginning of May, and did so to take us to this all-time new record high here. But then we came off again last week, and that's where the previous triangle resistance line acted as support. And the same has happened again last Friday. As you can see here, we're holding above this previous resistance line, which now, because of inverse polarity, has become a support line. So let's look at where that is, and that's around the psychological 2000 mark. And if that and the Friday low from 2 weeks ago at $1,999 per troy ounce underpins, further sideways trading is likely to be seen. But if we were to see a slide through 1,999 take shape, we would then most likely reintegrate the sideways trading range we saw within the triangle for much of late April and early May, and that could take us back down again towards the 1,980 to 1,950 area. So from a technical perspective, provided we stay below the last reaction high, which was made at $2,048 last Wednesday, further downside is likely to be seen with regards to the price of gold. And silver, as you can see here, has also come off, the price of silver, but much more drastically. Here we've had a huge decline last Thursday, take us last week to $23.74 to a 1 month low. And it looks as if further weakness may be seen short term, which may then take us back down again towards the middle of this sideways trading range, which we've seen between December of last year and February of this year, around the 2350 area or so. So that is a possibility for the days and weeks ahead, simply because the momentum has shifted from the upside over the last few months to the downside, as you can see here on this daily financial bet. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.